Okay, so if we look at the conventional wisdom surrounding like legacy brick and mortar retail over the last decade or so, the narrative has been overwhelmingly uniform. Like it's just doom and gloom.
Oh, yeah, totally.
Right, because you look at the macroeconomic charts and they show inflation just, chewing away at household budgets. Fuel prices are remaining stubbornly high. Discretionary income is shrinking. So the standard Wall Street playbook dictates that in this kind of environment, physical retailers, especially ones with massive square footage and heavy inventory models, they're just supposed to struggle.
Yeah, the physics of the market suggests they should be weighed down by their own operational gravity, basically.
Exactly. We usually see consumer traffic slow down, baskets get smaller, and margins just compress because these companies are forced into crazy promotional discounting just to clear the racks.
Right, because the standard assumption is entirely built around defense. When the consumer is under pressure, the traditional department store or like a specialty apparel retailer just goes into this defensive crouch.
They just hunker down.
Exactly. They cut their capital expenditures, they try to renegotiate leases, and they just cross their fingers hoping for some kind of macroeconomic pivot.
Which never seems to come fast enough.
No, it doesn't. And we track these metrics across the entire retail sector. A correlation between consumer sentiment and retail top-line growth is usually airtight. It's almost a law of physics.
But then we get the Q1 2026 earnings call for Ross Stores, trading under the ticker symbol ROST. And I mean, looking at this transcript, that operational gravity we just talked about, it literally doesn't seem to exist for them.
It really doesn't.
The financial and diagnostic landscape they presented here is just a complete structural inversion of everything the broader market is experiencing right now.
Yeah, it's wild.
We are looking at a retailer operating physical boxes in strip malls, and they're putting up growth numbers you would typically associate with, like a software company scaling some new digital product.
It is a remarkable departure from the sector average. I mean, the broader retail environment is seeing, flat to maybe low single-digit growth.
If they're lucky.
Right, with many heritage brands actually contracting. But Ross, on the other hand, is accelerating. And the underlying data from this call indicates that this isn't just, a temporary blip or some accounting anomaly.
No, not at all.
There is a fundamental shift happening in their market positioning, their inventory procurement, and their demographic reach.
So welcome to this deep dive. Today we are focusing on our Talk Tickers format. Our mission is to take the absolute mountain of data from this Ross Stores Q1 2026 earnings call, cut through the corporate speak, and just deliver a data-forward, highly opinionated analysis for you, the retail investor.
That's right.
We're going to break down the headline numbers, explore the actual logistical and psychological drivers behind this massive foot traffic, scrutinize their updated forward guidance, and deliver an actionable bottom line.
Because whether you are currently holding Rost in your portfolio, or maybe you're just tracking the off-price retail sector to gauge the broader health of the American consumer, this analysis is going to give you the exact underlying mechanics of what is driving this stock's momentum.
So let's just jump right into it. Let's start with the top line data because, wow. Total sales jumped 21% to $6.0 billion.
Yeah, that number is staggering.
That is a year-over-year increase of more than $1 billion in a single 90-day quarter.
Which is, moving an additional $1 billion of physical merchandise in that time frame requires an extraordinary level of operational velocity.
Yeah, this isn't software.
Exactly. We are not talking about processing more digital subscriptions or upgrading cloud tiers. This is physical throughput.
Right.
It requires moving millions of additional garments, shoes, home goods, all of it, through a global supply chain, onto distribution center conveyors, into trucks, onto the store floors, and physically scanning them through the checkout registers.
Just the logistics of that.
It's insane. For a mature business with a 40-year history, to scale its physical logistics by that magnitude without the entire system just breaking down is a massive operational feat.
And the profitability metrics followed the volume, which is key. Earnings per share, their EPS, soared 37% to $2.02. That's up from $1.47 in the prior year.
A huge jump.
But the metric that really, I think, demands scrutiny here is the comparable store sales. Their same-store comps grew 17%.
Yeah, that's the number that stopped me in my tracks.
Right. For anyone who follows retail, a 17% comp for a mature brick-and-mortar chain in 2026 is almost unheard of. CEO Jim Conroy noted this is the highest same-store sales growth in the company's entire history.
Over 40 years.
Yeah. Now, looking at this through an analytical lens, my immediate reaction to a 17% top-line jump in this current macro environment is I immediately question the pricing strategy.
Sure, you have to.
Right, because we know inflation has pushed up the cost of manufacturing and apparel across the board. So if a retailer simply passes, say, a 15% vendor price hike directly to the consumer, well, their revenue looks like it grew 15%, but they haven't actually moved any more product.
It's just an optical illusion.
Exactly. It's an illusion driven entirely by inflation.
And it is the necessary skeptical approach to take with literally any retail earnings report right now. Because revenue growth driven purely by price increases is incredibly fragile.
It's a house of cards.
Yeah. Eventually, you hit a ceiling where the consumer simply rejects a price tag and your volume collapses. But the transcript data actively disproves that inflation illusion theory for this quarter.
Yeah, they address it directly.
They did. During the Q&A, Tracy Kogan from Citigroup, she really pushed management on the specific composition of that 17% comp. She wanted the breakdown between ticket size, meaning the actual price of the items, and transaction volume.
And management's response to that was crucial because they confirmed that units per transaction were essentially flat.
Right.
The average basket size grew a little bit, slightly, but it was just a minor contributor to the overall sales growth. The overwhelming driver of this revenue explosion was pure, unadulterated foot traffic.
Which is the holy grail.
They experienced a massive increase in the sheer number of transactions. Like they're getting more unique human beings to pull their cars into the parking lot, walk through those automatic doors, and actually approach the register.
Which brings us to the profitability mechanics of that traffic. Because a surge in foot traffic only really benefits the bottom line if the unit economics of the store are optimized.
Right. If you're losing money on every customer, more customers doesn't help.
Exactly. But Q1 operating margin expanded 120 basis points to 13.4%. And that expansion was driven by two very distinct levers, which CFO Bill Sheehan outlined. First, merchandise margins improved by 85 basis points. And second, occupancy costs leveraged by 60 basis points.
Okay, let's contextualize that occupancy leverage for a second, because I think it is the core financial engine of physical retail.
It really is.
If we step away from traditional retail metaphors for a minute, think about it like a software as a service company running a server farm.
Okay, I like this.
Right. So the cost to keep those servers powered on and cooled is a fixed operational expense. If the SaaS company only utilizes 50% of their server capacity, that fixed electricity cost just weighs heavily on their profit margins.
Right, you're paying for air.
Exactly.
Yeah.
But if they suddenly onboard thousands of new users and push that server utilization to like 95% without having to build a whole new data center.
The fixed cost remains the exact same.
But the revenue generated from that existing infrastructure just skyrockets. The cost of the infrastructure as a percentage of total revenue just plummets.
And that is the exact dynamic happening inside Ross's physical locations right now. Their occupancy costs, the rent they pay for the physical box, the base utilities, the property taxes, the store management salaries, those are their fixed servers.
Right.
Whether 100 customers walk in or 1,000 customers walk in, the landlord charges the exact same rent. So by driving 17% more sales volume through the exact same real estate footprint, the cost of that rent as a percentage of total sales compressed by 60 basis points.
The infrastructure is just generating significantly more yield.
Precisely. And on top of leveraging the real estate, they are also expanding the merchandise margin, which you mentioned.
Yeah, the 85 basis point improvement.
Right. That means the spread between what Ross pays its vendors for the inventory and what the consumer pays at the register is actively widening. They are essentially sourcing their product at better wholesale prices, or they're relying far less on clearance markdowns to move stale inventory. Or both.
Probably both. And this is where we need to really examine the specific consumer behaviors driving this efficiency. Because if the comp is driven by foot traffic, and the foot traffic is highly profitable, we have to isolate who is suddenly walking into these stores.
Who is this new customer?
It's exactly.
Yep.
Management provided a very specific demographic breakdown. They noted a double-digit increase in customer count on a comp store basis with strong growth across all income levels, which is great.
Very healthy.
But the standout metric, like the one that really changes the long-term thesis for this stock, came when Dana Telsey from the Telsey Advisory Group probed into the age profile of these new shoppers.
Oh, this was fascinating. Jim Conroy stated that they are aggressively capturing the Gen Z demographic.
Yes.
Specifically the 18 to 24-year-old cohort. He mentioned that Ross is outperforming virtually every other retailer they track in acquiring this specific age group.
Which is a monumental shift.
It really is.
Because historically, off-price retail has relied on an older, family-oriented demographic. I mean, the primary shopper was usually a suburban parent looking for value on back-to-school clothes or like home goods.
Yeah, it wasn't exactly cool.
Right. So the idea the digital native, hyper-connected 18-year-old is suddenly bypassing fast fashion e-commerce apps to physically drive to a Ross dress for less.
Oh.
That requires a really deep dive into modern consumer psychology.
It does.
Like, how is an off-price brick-and-mortar store winning the battle for Gen Z's attention against algorithmic, totally frictionless online shopping?
Well, it really comes down to gamification and the curation of discovery.
Okay, unpack that.
So e-commerce is highly efficient, right? If an 18-year-old knows they want a specific plain black t-shirt, they can find it online in 3 seconds and buy it.
Sure.
But that efficiency completely eliminates the dopamine hit of discovery. Gen Z consumer culture has heavily embraced this concept of the treasure hunt. We see this reflected everywhere in the massive popularity of thrift store haul videos on social media, like on TikTok.
Oh, absolutely. The hauls are everywhere.
Right. There is a huge cultural cachet attached to finding a rare, high-quality, or designer item hidden among just generic inventory and getting it at a steep discount. So Ross essentially provides a sanitized, brand new version of that exact thrift store treasure hunt.
And Brooke Roach from Goldman Sachs actually asked about the marketing strategies facilitating this. And Conroy pointed to a modernized creative message and a real shift in their media mix to contemporize the brand.
They're meeting them where they are.
Right. They are essentially injecting themselves into that digital conversation, framing a trip to Ross as an event rather than just a chore.
Oh.
But, marketing is just the top of the funnel.
Oh, completely.
You can run the most brilliant viral social media campaign in the world, and it will get an 18-year-old into your store exactly one time.
Just once.
Because if the merchandising doesn't align with their expectations, like if the racks are just filled with outdated styles or generic brands nobody wants, that customer churns immediately and they never come back. The retention strategy relies entirely on what is actually sitting on the shelves.
Which forces us to look at their inventory procurement strategy, because this is the secret sauce. Specifically, their reliance on what is called pack-away inventory.
Yes. Let's talk about pack-away.
So the transcript notes that total consolidated inventories at the end of the quarter were up 12% to support all that massive sales volume. But within that total, pack-away represented 36% of the inventory, compared to 41% last year.
I really want to spend significant time on this pack-away mechanism because it seems to be the primary structural advantage that off-price retail has over traditional department stores.
This is their biggest weapon.
Because tying up over a third of your total inventory in off-site storage is a massive capital allocation decision. You are essentially taking hundreds of billions of dollars in liquid capital and converting it into physical goods that won't even see a sales floor for months.
Right.
And in a macroeconomic environment where capital is super expensive and interest rates are elevated, the carrying costs of holding that inventory in distribution centers must be substantial.
Oh, it's not cheap.
So the margin return on those items has to be extraordinary to justify locking up that much cash.
Well, the math on pack-away is fascinating. And you're right, it only works if the initial purchase price is at an extreme, highly distressed discount.
Walk us through an example of how that happens.
Okay, consider the supply chain vulnerability of a traditional apparel vendor. Let's say a premium brand manufactures 50,000 winter coats based on really aggressive sales forecasts from mainstream department stores.
Like a Macy's or a Nordstrom.
Exactly. But if consumer spending suddenly slows down, or if the winter is just unseasonably warm, those department stores cancel their future orders.
Ouch.
Right. So the vendor is suddenly paralyzed. They are sitting on massive volumes of out-of-season, highly specific inventory, and their own capital is trapped in those coats.
And they can't just liquidate it through their own premium channels without destroying their brand equity.
No, they can't.
Because if a $200 designer coat suddenly shows up on the brand's own website for $40, the consumer is trained to literally never pay full price again.
Right. The brand's pricing power just evaporates overnight.
So they do.
They need to liquidate it quietly. And this is where Ross deploys its capital. They step in and purchase that entire lot of 50,000 winter coats. but they are buying them in February for 10 cents on the dollar.
Wow.
Ross takes immediate physical possession, relieving the vendor's logistical nightmare, but Ref doesn't put those coats in their stores in February.
Because nobody's buying winter coats in February.
Exactly. They pack them away in their distribution network. That's the pack away. They absorb the holding costs, the warehouse space, and the capital lockup for, say, 8 months.
Right.
But then when October arrives, they release those premium brand name coats to the store floor at a price point that still offers the consumer a massive discount, say $80 for that $200 coat. But it yields an enormous margin for Ross because they bought it for $20.
It is literally a form of chronological arbitrage.
That's a great way to put it.
They are leveraging their massive balance sheet to buy time. They buy when the asset is distressed and completely out of season. They hold it, and then they sell it when the seasonal demand returns.
Yes.
And because they are executing this across thousands of different brands and product categories simultaneously, that 36% pack-away metric represents an incredibly diverse war chest of margin-rich inventory just waiting to be deployed.
And this capability dictates the power dynamics of the entire apparel supply chain. During the call, Lorraine Hutchinson from Bank of America questioned management on inventory availability. She wanted to know if Ross could actually source enough high-quality product to sustain a 17% growth rate going forward.
Right, because eventually you run out of distressed coats.
But management's response highlighted their absolute dominance in the liquidation market. They stated they are getting first call.
First call. That concept of the first call is the ultimate moat in off-price retail.
It is everything.
Because if a vendor needs to move millions of dollars of excess inventory by Friday, they aren't going to call some regional discount chain with 50 stores.
No.
That smaller chain doesn't have the cash reserves, and they certainly don't have the logistical capacity to absorb the physical volume quickly enough. So the vendor calls the player who can write the check immediately and take the problem away in one fell swoop.
Which is Ross.
Right, because Ross just added $1 billion to their top line. Their liquidity and their physical throughput capacity make them the single most attractive problem solver for desperate vendors.
It creates this beautiful self-reinforcing flywheel. High sales volume generates immense cash flow. That cash flow allows them to be the buyer of first resort for the absolute best distressed inventory in the entire market.
Right.
And then procuring the best brand name inventory at the steepest discounts drives more consumer foot traffic, which in turn drives higher sales volume. Round and round it goes.
And we see the direct result of this flywheel in the specific merchandise categories that outperform this quarter. Because while management noted that every major category posted comp growth in the teens, they specifically highlighted ladies' apparel and cosmetics as the real standout drivers.
Yeah, the cosmetics numbers were fascinating.
Christina Katai from Deutsche Bank focused on that cosmetics performance. She asked if the growth was driven by expanding the physical footprint of the beauty department in the stores or by consumer trade down.
And Jim Conroy clarified that they have not materially increased the square footage allocated to cosmetics at all.
Interesting.
The massive growth in that category is pure productivity. The sales per square foot have just skyrocketed because they have fundamentally changed the desirability of the product mix. He explicitly called out the introduction of Korean beauty products, or K-beauty.
Which goes right back to the Gen Z thing. If we want to understand the actual mechanics of pulling an 18-year-old away from their phone and into a physical retail store, K-beauty is the perfect case study.
Oh, absolutely.
Because the K-beauty trend completely dominates social media algorithms. It is highly sought after, but traditionally it has been really fragmented to buy.
Right, it's not always easy to get.
It's often expensive, or it requires ordering from overseas with super long shipping times, or it's restricted to high-end specialty beauty retailers. So if Ross's buyers are successfully securing closeouts on trending, viral K-beauty brands and placing them right there on the shelf at an immediate discount.
They are weaponizing social media trends to drive physical foot traffic.
Exactly. The Gen Z customer isn't going to Ross to buy generic hand lotion. They are going specifically to hunt for that viral snail mucin serum they just saw on TikTok before someone else grabs it.
And from a unit economics perspective, cosmetics are just the perfect category to drive margin expansion.
Why is that?
Well, they take up very little physical space, right? And they require minimal merchandising labor compared to, say, hanging and folding hundreds of jeans and t-shirts.
Oh, that makes sense.
And they carry relatively high price points relative to their footprint. A single end cap of highly desirable cosmetics can generate the revenue equivalent of an entire aisle of bulky home goods.
Wow. So this aggressive targeting of new demographics and new high-margin product categories, it really suggests a structural shift in how the company actually operates day to day.
It does.
Anisha Sherman from Bernstein picked up on this during the Q&A, and she asked this really fascinating question about the internal corporate culture. She asked if there has been a deliberate shift in how decisions are being made at the executive level.
Yes, and Jim Conroy's response to that question might actually be the most revealing part of the entire earnings call.
Really?
I think so. He framed it as a transition from playing defense to playing offense. He acknowledged that historically the company culture was incredibly risk-averse.
Which makes sense for off-price.
Right. They were focused on protecting their existing market share and obsessively managing costs. But he stated they have now deliberately empowered their teams to be more entrepreneurial, to make faster decisions, and to aggressively pursue growth opportunities.
I think we need to contrast that internal cultural shift with the external macroeconomic tailwinds, though. Because Conroy was very transparent that the quarter started with a massive external catalyst, which was higher than expected tax refunds in February. When lower and middle income consumers get a sudden injection of cash, off-price retail usually sees an immediate spike. So if this massive quarter was solely a product of tax refunds, we would expect to see the sales velocity just completely collapse in March and April once those checks were spent.
Which is exactly why Conroy emphasized the timeline of the growth so heavily. He noted that while February was explosive, the underlying momentum stayed incredibly strong. It remained in the mid-teens for the rest of the entire quarter.
Wow, so it didn't drop off.
No. And that sustained performance completely removes the tax refund caveat. It proves that the internal initiatives, the modernized marketing, the Gen Z targeting, the improved brand procurement, all of that is generating sustainable organic demand entirely independent of macroeconomic stimulus.
So that transition from defense to offense leads us directly into how they are modeling the future. Because the Q1 numbers, they're historical facts at this point. But the market trades on forward expectations.
Right.
So let's analyze the management guidance for the remainder of 2026. The upgraded forecast is objectively strong, but if you look closely at how they constructed the numbers, that traditional Ross conservatism is still heavily embedded in the projections.
Oh, definitely. Let's break down the full year figures first. So they are raising their EPS guidance to a range of $7.50 to $7.74.
Okay.
This represents a 13 to 17% increase over last year's actual EPS, which was $6.61. Furthermore, they are projecting full year comparable store sales to be up 6 to 7%.
Now, the critical context for that 6 to 7% comp projection is the denominator they are working against. Because this growth is projected on top of a 5% gain from the previous year.
Right, they are comping the comp.
In retail mathematics, stacking consecutive years of high single-digit same-store sales growth becomes exponentially difficult because your baseline is constantly expanding. You are requiring your existing physical footprint to yield significantly more revenue year after year without adding a single foot of square footage to those specific stores.
Which is exactly why their strategy for adding new square footage is so vital to the long-term thesis. We know the existing stores are becoming more productive, but top-line revenue growth eventually requires putting new boxes in the ground.
You just have to build more stores.
Right. And they announced they are on track to open approximately 110 new stores this year, which equates to roughly a 5% growth in their total store base. But the geographic distribution of these new stores is where the narrative gets very interesting.
Yes. Dana Telsey and Chuck Grom both focused heavily on this geographic expansion during the Q&A, specifically the push into the Northeast and the New York market.
Yeah.
Now, this is an area where I personally maintain a high degree of skepticism regarding their unit economics.
Okay, why is that?
Well, Ross's legacy and primary density is in California and the Sun Belt. Their operational model is historically built around sprawling suburban strip malls, massive surface parking lots, and car-dependent consumers coming in and loading up very large baskets.
Sure.
Translating that model to the Northeast, and particularly the New York metropolitan area, that introduces a host of margin-crushing variables.
It's a completely different world.
Right. You are dealing with exorbitant commercial rent, highly unionized labor markets, and just absolute logistical nightmares for those 53-foot delivery trucks trying to navigate dense urban corridors. How does a retailer built on discount pricing generate enough volume to offset the massive increase in fixed operational costs in New York?
It is the ultimate stress test for an off-price business model, no question. But if you can make the margins work in the Northeast, the sheer density of the population provides an incredible growth runway.
Did they address it?
Yes. Michael Hartshorn, the COO, directly addressed the performance of these new markets. They exited the previous year with 12 stores in the New York area and added 2 more in the first quarter. And he stated unequivocally that these specific stores have far exceeded their expectations from an underwriting standpoint.
Meaning that before they signed those wildly expensive Northeast leases, their real estate teams built financial models projecting the required foot traffic and average ticket needed to just break even and hit their target margin.
Right.
And the actual physical reality of those stores operating in the wild is actively outperforming those theoretical models.
Exactly. And the variable that likely bridges the gap between those high operating costs and the profitability is just the sheer volume of foot traffic that urban density provides.
Volume cures all ills.
It really does. If your marketing is successfully capturing a younger, trend-focused demographic, and you place a store in a highly walkable, densely populated area, the velocity of inventory turnover can absolutely offset the higher rent.
So the product just moves faster.
Exactly. If a coat sits on a rack in a suburban store for 2 weeks before selling, but it sells in 2 days in a New York store, your capital efficiency improves dramatically.
Right.
Proving out this Northeast model is a massive catalyst for them because it opens up a vast new territory for their development pipeline that previously seemed, frankly, geographically incompatible with their brand.
But expanding into these expensive markets requires immense capital liquidity. But looking at their capital allocation strategy, liquidity does not appear to be a constraint at all.
Not even slightly.
Because alongside funding the store expansion, Bill Sheehan noted they remain on track to execute a massive shareholder return program. Specifically, they are repurchasing $1.275 billion in stock over the course of 2026.
And the scale of that buyback program serves 2 very distinct functions. Mechanically, it is a form of financial engineering that supports the earnings per share metric.
Explain that for the listener.
Sure. By using their free cash flow to buy their own stock on the open market and then retire those shares, they are permanently shrinking the total number of shares outstanding.
Right.
So even if their net income were to remain perfectly flat, the earnings per share would still increase simply because the profit is being divided among fewer total shares. It basically creates a synthetic floor under the EPS growth rate.
But beyond the math, the buyback is a huge psychological signal to the market. In an environment where the cost of capital is high and macro uncertainty is rampant, a management team executing a $1 billion-plus buyback is explicitly stating that they believe their own stock is deeply undervalued relative to their internal projections of future cash flow.
They're betting on themselves.
Exactly. They are allocating capital to their own equity because they see it as the highest yielding investment available to them. But, despite this confidence, management was very deliberate in outlining the macro headwinds that could pressure the back half of the year. The guidance was not a universally sunny projection.
No, the executive team was highly specific about the operational friction points they're modeling for, primarily revolving around supply chain logistics. Bill Sheehan explicitly warned that elevated fuel prices will severely pressure domestic and ocean freight costs moving forward.
Tracy Kogan actually brought up an interesting contradiction regarding this during the call, didn't she? Yeah. She pointed out that in Q1, domestic freight actually leveraged, meaning it became cheaper as a percentage of overall sales.
She did, and Sheehan's clarification on that point perfectly illustrates the mechanics of operational leverage we were talking about earlier.
Oh.
He explained that the freight leverage in Q1 was purely a mathematical byproduct of the massive 17% sales outperformance. The denominator grew so incredibly fast that it temporarily masked the rising costs in the numerator. But he warned that the actual nominal cost of moving goods is rising due to fuel, and as sales growth normalizes a bit, that fuel inflation will become a very visible drag on the margins.
Because fuel is just the unavoidable tax on the entire physical retail ecosystem.
Always.
Like e-commerce can sometimes pass digital transmission costs onto the consumer invisibly, but moving millions of physical garments requires burning bunker fuel across the Pacific Ocean, transferring containers to rail lines, and burning diesel fuel in semi-trucks to reach the distribution centers and the stores. When global energy markets spike, The margin on every single t-shirt and pair of shoes compresses.
And management is conservatively modeling for those energy costs to remain a persistent headwind. They also built conservatism into their guidance regarding potential capital inflows.
This was the tariff thing, right?
Yeah. Sheehan briefly mentioned that the company has submitted significant refund claims for historical tariffs. However, he stated that due to the ongoing uncertainty regarding the timeline of the government processing it and the ultimate amount they might actually receive, they have completely excluded any potential tariff refunds from their forward guidance models.
Which encapsulates the classic under-promise and over-deliver strategy perfectly.
Oh, textbook.
They are issuing raised guidance that projects massive full-year growth, but they're doing so while assuming high fuel costs will persist and completely ignoring millions of dollars in potential tariff refunds that could hit the balance sheet at literally any moment.
Right.
They are essentially presenting Wall Street with a worst-case scenario that still looks fundamentally exceptional. If fuel prices happen to moderate in the third quarter, or if those tariff refund checks suddenly clear, the actual earnings will violently gap up past the guidance they just provided.
It establishes a profound margin of safety for the investor. Because when a company models for macro turbulence and still projects double-digit EPS growth, the structural integrity of the business model is highly secure.
Which brings us to the ultimate synthesis of this deep dive. We have analyzed the historic volume of the Q1 revenue. We've dissected the demographic shift toward Gen Z and the margin mechanics of the K-beauty and pack-away inventory strategies. We've scrutinized the unit economics of the Northeast expansion and the deliberate conservatism of their forward guidance. So, looking at the totality of this data, what is the definitive bottom line on this stock?
Well, based purely on the operational mechanics revealed in this transcript, the verdict is incredibly bullish. We are witnessing a company that has successfully engineered a business model capable of deploying both offensive and defensive strategies simultaneously, which perfectly hedges them against the current economic environment.
Let's clearly define that dual advantage. Starting with the offensive capabilities, a retailer expands offensively by increasing its total addressable market, its TAM. And for decades, Ross's TAM was relatively static. It was budget-conscious, middle to lower income families looking for basic apparel and home goods at a discount. But Jim Conroy extensively discussed their new brand tiering strategy, which he referred to as the good, better, best assortment.
Yeah, Mark Altschwager from Baird focused on this specifically during the Q&A. He questioned how management is balancing the introduction of premium brands without alienating their core, price-sensitive customer.
The delicate balance.
It is. And Conroy acknowledged that in previous years, the company may have drifted a little too far toward the good category, meaning focusing almost entirely on extreme value, lower tier products.
The cheap stuff.
Right. But they have actively course-corrected. They are still offering the entry-level budget items, but they have aggressively expanded their procurement of better and best brands.
And this is exactly how you expand your TAM. By elevating the quality of the brands on the shelf, like offering a $60 designer jacket marked down from $200 right alongside the $10 basic t-shirt, they're capturing a much higher income demographic.
Exactly.
They are pulling in that brand-conscious Gen Z shopper and the affluent suburbanite who just wants the thrill of a deal on premium merchandise. They are raising the ceiling on who is willing to walk into the store, all without abandoning the core customer who relies on them for basic necessities.
That is their offensive superpower. The defensive superpower, on the other hand, is triggered by the macroeconomic environment itself.
How so?
Well, in a standard retail model, inflation, high interest rates, and shrinking household savings are catastrophic. Discretionary spending evaporates, and the consumer just retreats. But for the off-price sector, and Ross specifically, macroeconomic pain is actually an accelerant.
Because it initiates the trade-down effect.
Precisely.
When the middle-income household starts feeling severe pressure at the grocery checkout and the gas pump, their behavioral psychology shifts. They don't entirely stop buying clothes for their growing kids or replacing worn-out shoes, but they absolutely stop paying full retail price at the premium mall.
They refuse to.
They actively seek value alternatives. So this macro pressure creates a massive organic surge in consumer demand for Ross's specific value proposition.
And crucially, that macro pressure also solves their supply side equation. We discussed the first call dominance earlier. When the economy tightens, mainstream retailers panic. They slash their forward orders, they misjudge seasonal trends, and they leave premium brands choking on excess inventory.
Right.
The worse the broader economy gets, the more desperate vendors become to liquidate high-quality goods quickly.
It is a perfectly symmetrical counter-cyclical engine. A difficult macro environment simultaneously floods Ross with premium inventory at distressed wholesale prices from panicked vendors, while simultaneously driving a wave of new value-seeking customers through their front doors looking to buy that exact inventory.
It's brilliant.
It is a highly resilient mechanism that literally thrives on the inefficiency of the broader retail market.
So, synthesizing this for the portfolio strategy, if you are currently holding a Russ, the data suggests the fundamental health of the business is at a historic peak. The internal cultural shift toward an offensive entrepreneurial mindset is demonstrably working. The capital allocation is highly disciplined, and the flywheel of acquiring higher-tier brands to attract a younger demographic is gaining undeniable traction.
And if you are evaluating the stock from the outside, looking for an entry point, it functions as one of the few legitimate inflation hedges in the physical retail sector. It provides an operational moat against macro volatility while offering concrete, measurable growth catalysts in new, high-density geographic markets like the Northeast.
It just defies the standard gravity of the retail sector. It is a model engineered to accelerate precisely when the external friction increases.
Which leaves us with one final structural thought to consider. Throughout the entire duration of the earnings call, across multiple executive answers, from CEO Jim Conroy to COO Michael Hartshorn, there was one specific phrase they utilized repeatedly when discussing these initiatives.
Oh, I know what you're going to say.
They continually stated that they are in the very early stages.
Yes, they applied that caveat to almost every growth driver we discussed. The early stages of modernizing their marketing apparatus, the early stages of remodeling the store layouts, the early stages of their premium brand acquisition strategy, the early stages of their Northeast density rollout.
That is the variable that requires the most critical analysis from you as an investor. Because we just spent this entire deep dive dissecting a quarter where they generated a historic 17% comp, added $1 billion in top-line revenue, fundamentally altered their demographic base by capturing Gen Z, and expanded their operating margins significantly.
Yeah.
If a legacy retailer can execute all of that and fundamentally disrupt the physics of their sector while operating merely in the early innings of their internal transformation.
It's almost scary to think about.
Right. The logical question is, what does the terminal velocity of this company look like when these operational changes are fully matured? If this is what the beginning of the flywheel looks like, the market may be severely underpricing the eventual ceiling of this enterprise.
It's a great point to leave off on.
So thank you for joining us for this extensive Talk Tickers breakdown. We encourage you to pull the transcripts yourself, verify the metrics, and continue to question the established narratives. Because occasionally you find an operation that simply refuses to play by the standard rules of retail physics. Keep digging into the data, and we will catch you on the next deep dive.